Hey everyone, welcome back to our channel where we talk about personal finance, investing, and everything related to money. In today's video, we're going to talk about the effect of tax on making certain financial decisions. First, let's define what we mean by tax. Tax is a mandatory financial charge or levy that is imposed by a government on individuals, businesses, and other entities based on their income, property, transactions, or other factors. The purpose of tax is to fund public services and programs that are essential for the functioning of a society, such as education, healthcare, infrastructure, defense, and social welfare. There are different types of taxes, including income tax, property tax, sales tax, excise tax, payroll tax, and corporate tax. The tax rates and rules vary depending on the country, state, or municipality, and can be subject to change over time. Taxes can be progressive, meaning that the more you earn, the higher percentage of your income you pay in taxes, or regressive, meaning that the lower income earners pay a higher percentage of their income in taxes. Taxation is a critical component of any modern economy, as it allows the government to raise revenue and allocate resources efficiently. Taxes can also be used as a tool to influence behavior and promote social goals, such as reducing pollution, encouraging charitable giving, or supporting small businesses. Taxation can have a significant impact on individuals, businesses, and the economy as a whole. For instance, high tax rates can discourage investment, innovation, and entrepreneurship, while low tax rates can stimulate economic growth and job creation. Tax policies can also affect income inequality, consumer behavior, and the distribution of wealth. Now, how does tax affect our financial decisions? Taxes can have a significant impact on our financial decisions in many ways. One of the most obvious ways is through the direct effect on our income. Taxes reduce the amount of money we take home from our paychecks, which can impact how much we can spend, save, and invest. This can influence our decisions about where to live, what job to take, and how much we can afford to spend on things like housing, transportation, and entertainment. Taxes can also affect our investment decisions. For example, capital gains tax rates can influence whether we choose to invest in stocks, real estate, or other assets. Capital gains taxes are usually lower than ordinary income tax rates, which can make certain investments more attractive than others. For instance, if you're considering buying a rental property, you'll want to consider the tax implications of that investment. Rental income is taxed at your ordinary income tax rate, which can be as high as 37%. On the other hand, long-term capital gains tax rates are lower, which can make stocks and other investments more attractive than real estate. Another way taxes can impact our financial decisions is through deductions and credits. Deductions reduce your taxable income, while credits reduce your tax bill dollar for dollar. For example, if you're a homeowner, you can deduct mortgage interest and property taxes, which can lower your overall tax bill. If you're a parent, you may be eligible for the child tax credit, which can reduce your taxes by up to $2,000 per child. These tax benefits can influence our decisions about how much to spend on a home, how many children to have, and whether to make charitable donations. Furthermore, taxes can also impact our decisions to donate to charities or contribute to retirement accounts. Contributions to a traditional IRA or 401 are tax deductible, which means you can reduce your taxable income and save on taxes. Similarly, charitable contributions are also tax deductible, which can incentivize people to give more to causes they care about. These tax benefits can encourage us to save for retirement, be more charitable, and think more long-term about our financial goals. It's worth noting that taxes can also impact our decisions to work and earn more money. As our income increases, we move into higher tax brackets, which means we pay a higher percentage of our income in taxes. This can create a disincentive to work harder and earn more, as we may end up taking home less money after taxes. This phenomenon is known as the tax wedge, which refers to the difference between the pre-tax and after-tax income earned from working. The tax wedge can influence our decisions about how much to work, whether to take on overtime or a second job, and even whether to move to a higher-paying job in another state or country. Another way taxes can affect our financial decisions is through deductions and credits. Deductions and credits are two ways that taxpayers can reduce their overall tax liability. Deductions reduce the amount of income that is subject to tax, while credits reduce the amount of tax owed on that income. Both deductions and credits can be claimed on your tax return and can have a significant impact on your tax bill. Let's start with deductions. Deductions are expenses that the IRS allows taxpayers to subtract from their gross income to arrive at their taxable income. Taxpayers can either take the standard deduction, which is a predetermined amount set by the IRS, or they can itemize their deductions, which means they list all of their eligible expenses individually. Some common deductions include mortgage interest, state and local taxes, charitable contributions, and medical expenses. For example, if you paid $10,000 in mortgage interest and property taxes last year, you can deduct that amount from your taxable income. If your taxable income was $50,000, your deduction would reduce your taxable income to $40,000. Now, let's talk about credits. Credits are dollar-for-dollar reductions in the amount of tax owed. There are two types of credits, refundable and non-refundable. Refundable credits can reduce your tax bill to zero and may even result in a refund, while non-refundable credits can only reduce your tax bill to zero. Some common credits include the Child Tax Credit, the Earned Income Tax Credit, and the American Opportunity Tax Credit. For example, if you have 2 children and qualify for the Child Tax Credit, you can reduce your tax bill by up to $4,000. If your tax bill was $6,000 before the credit, it would be reduced to $2,000 after the credit. It's important to note that not all deductions and credits are available to all taxpayers. Some deductions and credits have income limits or other eligibility requirements. For example, the Child Tax Credit is only available to taxpayers with children who meet certain age and residency requirements. Similarly, the deduction for student loan interest is only available to taxpayers who meet certain income requirements. Furthermore, taxes can also impact our decisions to donate to charities or contribute to retirement accounts. Taxes can have a significant impact on our decisions to donate to charities or contribute to retirement accounts. Let's dive deeper into this topic. First, let's talk about charitable contributions. When you make a donation to a qualifying charity, you can deduct the donation on your tax return, which can reduce your taxable income and lower your overall tax bill. This is because the government incentivizes charitable giving by allowing individuals to deduct their donations from their taxable income. This can be especially beneficial for people who are in a higher tax bracket. For example, let's say you're in the 35% tax bracket and you donate $5,000 to a qualifying charity. You can deduct that $5,000 from your taxable income, which means you'll save $1,750 in taxes. So your actual out-of-pocket cost for the donation would be $3,250 rather than $5,000. On the other hand, if you're in a lower tax bracket, the tax benefits of charitable contributions may be less significant. For instance, if you're in the 12% tax bracket and you donate $5,000, your tax savings would only be $600. In this case, your out-of-pocket cost for the donation would be $4,400. Now, let's talk about retirement contributions. Contributing to a retirement account, such as a traditional IRA or 401, can also provide tax benefits. Contributions to these accounts are tax deductible, which means you can reduce your taxable income and save on taxes. This can be especially beneficial for people who are in a higher tax bracket and want to reduce their tax liability. For example, let's say you're in the 32% tax bracket and you contribute $10,000 to a traditional IRA. You can deduct that $10,000 from your taxable income, which means you'll save $3,200 in taxes. So your actual out-of-pocket cost for the contribution would be $6,800 rather than $10,000. On the other hand, if you're in a lower tax bracket, the tax benefits of retirement contributions may be less significant. For instance, if you're in the 12% tax bracket and you contribute $10,000 to a traditional IRA, your tax savings would only be $1,200. In this case, your out-of-pocket cost for the contribution would be $8,800. It's worth noting that there are limits to how much you can contribute to retirement accounts and how much you can deduct for charitable contributions. For instance, in 2023, the maximum contribution to a traditional IRA is $6,000, and the maximum contribution to a 401 is $20,500. Charitable contributions are also subject to limits based on your income and the type of organization you're donating to. It's worth noting that taxes can also impact our decisions to work and earn more money. As our income increases, we move into higher tax brackets, which means we pay a higher percentage of our income in taxes. This can create a disincentive to work harder and earn more, as we may end up taking home less money after taxes. In conclusion, taxes can have a significant impact on the way we make financial decisions. It's essential to understand the tax implications of our choices to make informed decisions that align with our goals and values. That's why it's always a good idea to consult with a financial advisor or tax professional to help you navigate the complex world of taxes and finance. That's all for today's video. Thanks for watching, and we'll see you in the next one.